So let's talk about de-dollarization and dollar debasement today. Now, there is a sense of panic in Washington that the dollar has to be safe at all costs. And that's why we are seeing Trump running to shore up support from his allies in Asia. Now, sure, tariffs, they are a big part of it, but protecting dollar hegemony is another. When Besant visited Japan, he didn't even press the BOJ to hike rates. In fact, he was very docile and he focused on keeping exchange rates stable, which means he doesn't want the dollar to crash further in the markets. He needs stability for the currency. The demand for US bonds has to be protected here. Year to date, the dollar has lost almost 10% of its value, and chances are it will continue to drop thanks to the global tariffs. And that complicates things for countries looking to borrow money in dollars. This hammers down overall demand for the USD. Countries would rather just issue their own local currency bonds if interest rates are low enough. In the first 5 months of 2025, countries are issuing less and less dollar bonds. Total issuance by non US sovereigns has dropped by 19% to just $86 billion. This is the first decline in 3 years. If the dollar continues to drop, if the tariff war has no end in sight, countries will continue to reject USD issuance, and this will begin yet another cycle of dollar devaluation. Demand for the currency will continue to drop. Now, the situation continues to get worse, especially during this era of bloc competition. The G7 might cling on to dollar bond issuance, but BRICS is moving away from this tradition, and China is the biggest beneficiary of this move. Indonesia just issued their first offshore bond, and its sovereign debt denominated in the Chinese yuan, and this is done through dim sum issuance. It's an offshore bond sale done outside of China, so international investors can easily buy them. Now, Indonesia needs more funding sources, and here's the key agenda. They are looking for diversification away from only dollar reserves. Even if we take away dollar weaponization, relying on USD funding is a serious problem. You need to constantly collect dollars from trade with the US, and considering the state of the tariff war, that isn't a guarantee. It's critical we understand the flow of money between Indonesia and the United States. They are facing a very lopsided deal with the US because of the trade surplus. Trump's reciprocal tariffs were done in order to punish countries that sold more to the US than what they bought. Let's not forget that. Indonesia exports over $24 billion worth of goods to the US last year. The US exports only around $10 billion to Indonesia. So there is a trade surplus of around 14 billion, but that is going to shrink. Trump's 19% tariff on Indonesian goods will reduce exports to the US. Dollar revenues will go down. At the same time, Indonesia is removing 99% of the trade barriers on US goods. So more dollars will be leaving the country and paying US exporters, another outflow of dollars. Indonesia will also purchase almost $20 billion in US energy and farm products. And let's not forget $3.2 billion in US planes as well. Dollars are once again leaving the country. Many countries around the world, they are operating under this backdrop, especially those in Asia. They are facing big tariff walls from the US, so getting dollars will be harder. If you start issuing sovereign debt in dollars, you'll be in double jeopardy. If a crisis happens and you're short of dollar liquidity to pay back your creditors, things will look very nasty. We have yet another Argentina situation where your local currency enters a crisis. It could even escalate towards an IMF bailout if things get nasty enough. But of course, the big winner of this is China. Countries and companies globally are issuing more and more RMB bonds. Just dim sum notes alone today clocked in at 720 billion yuan. That's $102 billion worth. This is a rise of 8% from a year earlier. In fact, the amount has been rising since 2022, when the US decided to raise interest rates. Global economies are headed for another dollar liquidity squeeze, but for a very different reason. Now, Trump's trade war has consequences and everything is interconnected. Unwittingly, he's actually strengthening China's position, not just in global trade and exports, but demand for the RMB as well. Many economies and companies, they now have a greater incentive to issue RMB bonds. It's not some big conspiracy, but simply because of trade flows. In September, Chinese exports to the world grew by 8.3%, and that's despite trade with the US collapsing down. Overall trade is still rising. Chinese EV exports have risen by 11%, semiconductors up by 30%, and ships up by 40%. Countries from Asia to Africa to Europe and Latin America are increasing their imports of Chinese goods. This just increases the demand for China's currency now. You're going to buy stuff from the Chinese anyways, so you might as well borrow money through the RMB currency. The longer this trade war drags out, the worse it's going to get for dollar demand. Conversely, the longer this continues, the better it's going to get for the Chinese RMB. Meanwhile, Chinese companies themselves, they're starting to move away from dollars as well. Exporters and importers are beginning to get out of US currency at alarming rates. Chinese banks sold almost $52 billion of foreign exchange in September. That's just in 1 month. Their clients, the exporters and importers, they're moving money back to the RMB. Optimism towards the Chinese currency is growing, and the higher it climbs, the worse the dollar dump is going to get. It's easy to confuse why the central government is allowing the RMB to strengthen. Isn't a cheaper RMB better for the export economy? And this is where Trump's trade war has backfired magnificently. When you raise trade barriers of 10 to 30% to the world, countries, they're now very desperate for cheap inputs. Chinese goods have already been cheaper by magnitudes for a very long time. Even if the RMB appreciates by another 10%, demand for these goods is still red hot. And that's more or less the only way to climb over US tariffs. China is also a massive market for the world. Now, US companies might be decoupling from them, but many regions, including Europe, are still highly dependent on China for revenue. EU companies like L'Oreal, Remy, Mercedes, and Volkswagen, they have exposure of 20 to 40% to Chinese sales. That's a big dependency that will only grow because China doesn't have tariffs on their products yet. So Chinese importers do have the ability to demand payment terms. Some settlements might be done in euros, but chances are the majority will be done in the RMB. And this will only intensify as the dollar continues to drop. The longer the tariff war persists and the bigger the Chinese consumer class grows, the bigger the shift to the local currency. Now it's all about leverage here. The US is losing theirs, China is increasing theirs, while Europe has none. The decoupling is helping the RMB strengthen, which will eventually support their capital markets. Now, at this point, the trend is undeniable. Between 2022 to 2025, the RMB was crushed because US interest rates were rising. But there was still some free trade between the US markets and the world back then. So dollar demand was strong and the RMB weakened. But now things have flipped. Now the trade war is shifting demand to the Chinese currency. And should it strengthen by another 2%, we could see hundreds of billions more of dollars get dumped. Importers and exporters will want to get out of Dodge. So it's quite crystal clear here. De-dollarization will get worse. Chinese markets will benefit, Chinese imports get cheaper, and this will boost local consumption in a very significant way as well. While all this is happening, the dollar is facing yet another debasement crisis. Now, debasement is a fancy way of saying the currency is going to lose more value over time. Trump is very proud of US tariff income, but as you'll see, it doesn't really move the needle. US government spending is out of control now.
I said, check the tariff shelf. Well, those tariffs haven't kicked in. Yes, they did. They kicked in 2 months ago. Check it. He comes back 2 hours later. Sir, you were right. We have an additional $31 billion, billion, not million, Lindsay, billion, that we just found from tariffs. They kicked in earlier than we thought. You were right. We're a wealthy nation again, and we're a nation that can be secure.
But I want us to take a step back and take a look at these two charts I'm about to present. It tells us that the debasement trade is not over yet, and why a default is coming sooner or later. Trump and Besson are right about tariffs. Custom revenues, custom duties collections is up. Revenue has grown by 153%, collecting almost $120 billion. but the CBO still predicts a horrendous deficit in 2025. Now, last year it was 1.8 trillion, and this year it is still 1.8 trillion. Why? Because spending across the board is still increasing. And this includes social security, defense, Medicare, and of course, interest payments on the debt. This is the basis of fiscal dominance. Nothing can stop this train until it derails and reality forces things to a screeching halt. And this is forcing Trump to choose between two impossible choices. Either he turns up inflation to dilute the debt away, or he allows interest costs to consume the entire US economy. Now we are nearing the point of no return because spending can't afford to calm down, not when he's fighting an economic war with China. Interest expense on the national debt has hit $1.2 trillion. That is an incredible amount of money. This means for every dollar of revenue collected, 23 cents is spent just to service the debt. It's the highest level in 25 years. It's a doubling in just 4 years. This is not sustainable. Even with the tariff revenue, you can't keep this up for long. Trust in the entire system will deplete even further. This crisis is a function of two things: out of control spending and interest rates staying higher today. We are still at 4% on the 10-year, and there's only one way to prevent an implosion at this point. The Federal Reserve and the US Treasury, they will need to work together. Bassett will need to shift bond issuance from the long end of the curve all the way to the short end. So we are talking about more issuance on the 1 month to 12-month T-bills. At the same time, the Fed will need to drop interest rates as fast as possible. And that's perhaps the only way to escape, the only escape route left when you need to keep spending. It's a big tragedy. And that's why today we can expect the Fed to cut rates once again, at least 25 basis points. The odds of one is astounding, and Powell is literally pressured to make it happen. There's now a 99.9% chance of a cut, which means if it doesn't happen, we can expect a crash in US stocks and US bonds. However, it also means currency debasement is baked into the cake. Knowing this, we know the debasement trade isn't over yet. And that's why, despite the AI bubble, money is still flowing into expensive US stocks. Just look at Nvidia, it's up by another 3 to 5%. The fear of a devalued dollar is bigger than the fear of the bubble popping. The spending can't possibly come down because China is wrapping up the heat as well. China and Southeast Asia just upgraded their free trade agreement. This is a big one. So now de-dollarization and Chinese trade is just going to grow further. Trump and Bassett has no choice but to keep subsidizing their industries and to keep the spending up. We have to brace ourselves here. Currency debasement is still on the menu, and we ain't seen nothing yet. The main event is yet to come. But let me know what you think. Will BRICS continue rejecting dollar loans? And how far will China de-dollarize? Let me know in the comments below. Stay safe. Be sure to smash the like button and subscribe as we navigate through these crazy times.